Okay, welcome back traders. We are going to have a look at an example of our key equity hedge, but we're going to start with our first trader, John. And what we're going to do is we're going to build this example up from the ground up. So we're going to have a look at a basic spread trade, and our trader here, John, is going to be placing a spread in the market. He's selling 4 calls and selling 4 puts. The price of the S&P is doing that on the underlying index, the S&P futures, and he's selling S&P options, and the market's currently at 838. He's selling four of the calls at 940 and 4 puts at 740, and he brings in a total there of around about 6 points, which is $6,000. Now, he's not buying any protection, not buying any calls, buying any puts. He's just going to basically sell calls and puts in the market at what we call, and what you'll start to now be well aware of, is out of the money options. So he's selling these calls and puts away from the market with a delta of around about 11 or 12. So he's got a around about 11% probability of being hit on those trades. So it's a fairly low risk trade as far as the market moving to that strike point. However, he does have unlimited risk with this strategy, and he also has the potential for margin exposure as well. Now, it's a 60-day trade, but we've got to remember that anything can happen in those 60 days. So ideally what he wants to see happen is the market finishes between his strike points, so his 940 and 740 strike points, and if that happens, obviously he gets to keep his $6,000, so everyone's happy. Let's have a look at what happens if the market actually finishes at around about 969 at the end of the option contract. Well, it's not good news for John, because John decided that he was going to save a bit of money on buying any type of outside protection, so buying any calls or puts, and that would obviously give him a higher premium that he brings in. But what he's done there is he's exposed himself to unlimited risk and potential margin pressure. So every time that the market moves, every day the market moves closer to these strike points, John's account would be coming under margin pressure, which would mean that, from our previous videos, that would mean that he would be required to potentially put additional funds into his account to meet the daily margin or maintenance margin. The market rallied pretty hard and has ended up at 969. So the seller, being John, because he's sold these options in the market, remember he has an obligation, he's now obligated to meet that price at 969. So what does that mean? It's actually 29 points above where his position is. So his calls are at 940, the market's at 969, so there's 29 points that he has to come up with. So 29 times 4 times 250 is about $29,000. Now his premium he bought in was $6,000, so we take that away from his obviously his net loss on the trade, and John ends up with a negative value of $23,000 on the first trade, so which is around about a 23% loss on his portfolio. Traders do well consistently because they have a higher probability of winning. It only takes one bad trade, as you can see there, to do a fair bit of damage to your account. So that's obviously a very, very aggressive way to trade spreads. I'm going to show you a little bit more conservative way, and then we're going to show you our strategy. Okay, so we push over here to protecting our sold position. So this is Bill. Bill's trader number 2. Now he's had a little bit more experience than John, and he decides that he's going to set exactly the same spread trade, except he's not comfortable with having unlimited risk, and he's obviously done his research, and he knows that that to be a spread trader you've got to stay in the game, and that means protecting your capital base. So he decides that he's going to do exactly the same spread, but he's going to buy calls at 960 and puts at 720. So he's basically buying positions above and below his sold strike points of around about 20 points above and 20 points below, just to make sure he caps his risk. So remembering that means that if he buys an equal number of calls and an equal number of puts, he has a maximum risk for the trade of 20 points. So 940 take away 960, 20 points. So remembering the market can't be in both the call and put position, so he only has one level of exposure, so that's 20 points. So remember that Bill, to do this, he actually had to pay away a little bit of money for the protection, which is 3 points. And that he takes that away from his initial premium, and that brings him a net premium of $3,000. Now, unfortunately for Bill, he suffered the same fate as John and had a losing trade, but his loss is obviously a lot less than than John's is. So he's a seller again. He has an obligation, so he sells his calls at 940. And remember that his actual bought position was 960, so he's caps his risk. So he actually takes a 20-point loss on that trade, minus his premium takes him down to $17,000. So on that trade, one trade, he loses 17% of his portfolio. Now, Bill's done really well. He's been obviously trading this strategy for about 6 months. He's accumulated around about $18,000. So he's still up. He's still up $1,000, but obviously 6 months of trading has been wiped out. He's wiped out all of his profit over 6 months. He's still in the game, hasn't suffered a fatal loss, and he had maximum. He had also had his obviously he had his margin protected, because as the market pushed up towards his sold calls, his margin was capped, so he wasn't required to put additional funds into his account, which obviously was good for Bill. Now have a look at how our strategy would have performed based on our head. Alright, so how does our strategy differ from what you've seen so far? Well, I'm glad you asked, because I'm going to take you through the strategy, and we're going to see a live example of how we performed during this period where the market rallied and obviously put a fair bit of pressure on those sold. And this is on our spread setup, so our 4 bought calls, 4 sold calls, 4 bought puts and 4 sold puts. So that's our box there. And what we have here, now that's our spread, our basic spread strategy. And here's the key to the whole thing. This is our futures proprietary indicator or system. And this is what we use to hedge ourselves. So remember, you would have gone through the video already with Luke, and he would have spoken to you about the requirement to hedge against our option spreads, because what we're looking to do is protect our spread. So we saw that Bill and John didn't do a very good job really of protecting their spread. They left themselves open to potentially that large move on the market where you anticipate that your spread's wide enough, but you only need one really strong move against you, and that can wipe out months of premium. So the idea here is that we protect our position to hedge the spread that we're trading. So we're going to show you in a little bit more detail about that, but what I'm going to show you is how effective this works. So this is the day that we set the spread, and we've got a short position here on our futures. So that meant that for every spread that we set, we take one large futures contract for every full spread. So we see here that this is our trailing stop here. So we're in the market at the moment there, and we'll just mark that at 847. We're short from 847.